Hello, my dear students. Welcome you all. So today I am going to start revision lectures for May 2024 CA Inter Advanced Accounting paper. So first I am starting with Accounting Standard series. So I am going to release each and every standard one after another so that you have enough time to prepare. And the uniqueness of this revision is I want to cover each and every point from study material, each and every example from study material. Now, once the standard is completed, I am going to cover MCQs from study material also. And also, wherever it is required, if I feel, definitely I am going to solve the questions also. Now, ICI study material should be the base for your preparation. Our first object is to cover everything from study material. So, keeping that objective in mind, so I have prepared a notes which contain everything from study material. Only the things which are repeated, only the things, the paragraphs which is not giving any new points, new insights, I have removed it. Apart from that, entire study material is covered. So because what I believe is, in order to answer MCQs, so you should know more number of points. So for that, I say study material should be your first source. So you should cover all the important points. You should cover all the points from study material. Now, once you cover everything from study material, I can say pretty much confidently that you are going to face the exams with the utmost confidence, and I'm sure that you are going to score good marks. So that is the uniqueness of this revision lectures. Now, one more point I want to bring with you is these are revision lectures, so that my main object is to cover everything, but in a pretty speed. I want to take less time to cover as many points as I can. So those who already listen to the accounting standards, so definitely these lectures will help you. So to cover everything quickly. And previously you might have learned accounting standards from some other materials where so many points are missed from study material, or where you learn the accounting standards in a shortcut manner. See, learning accounting standards in a shortcut manner is okay, but it is not okay in new syllabus. Till old syllabus it's okay, because in old syllabus, so the number of chapters are more, the number of standards are less. But in new syllabus, you see almost 80 to 80% of the syllabus is relating to new standards only, and standards only. Therefore, what I am guessing is the entire question paper you will see accounting standard question paper. Almost 80% of the paper will be their accounting standard related questions, and you have 30 marks MCQs. So anything can be asked as an MCQ. So we can't take chance. Even suppose a small slightest of point which you consider not important, but the person who is setting the paper may think he can frame an MCQ from it. So we can't take any chances. See, I'm not saying that whatever the MCQs which is there in the study material, or whatever the MCQs there in other material, other material will come directly. But at least you should practice some MCQs. So practice will make you perfect. To understand how an MCQ can be framed, so to get that grip over MCQs, at least you should prepare, moderately some MCQs. At least you should cover ICI, study material MCQs. That should be my opinion. Again, in order to answer MCQs better, you should know the subject elaborately. First, you need to cover everything. Sir, how to cover everything? Read study material. So in this revision videos, my main object is to cover study material. So see, study material seems may not be colorful, or may not be in a shortcut manner. So it will be elaborate, it will be in paragraph wise. So but trust me, once you listen to me, once you listen to these lectures and revise one or two times, I think you will feel the difference. So in examination halls you can score better. So I'm definitely confident. So you are going to rock the exams. Once you prepare every point from study material, you will get a lot of confidence, and you see that difference in examination hall. What is the difference, sir? Suppose if I prepared from an author material, or if I prepared from a study material, what's the difference? If I prepare from an author material now, so nowadays the authors are also copying pasting from study material only, but they're putting their name. So exclusive rights reserved. Everything is copied from study material only. See, no unique point is available from that author book. Everything is dumped from study material only. So why we need to follow other materials? Or why we need to follow any other material which is nothing but the copy paste of study material? So if any material, any book is giving you any value addition, so that book you can prepare. Suppose if it is not giving any value addition, and if it is not covering everything from study material, then what's the use? What's the use? You don't get advantage by preparing those kind of books. So my suggestion is, since you are writing exams which is conducted by ICI, so whatever the materials which is released by ICI, first prepare them. Whatever the questions in ICI material, first prepare them. MCQs in ICI, first prepare them. Then if you have a time, then you allocate your time to other sources. If you want to prepare, you can prepare. So please keep all those things in mind. And these standard series, what I'm going to release is helps to everybody, to other professional students like CMA inter students or CS students can also make utilize of these series, because accounting standard everywhere, the content, the main content is same. Of course, the way of presentation, the additional points. Suppose CMA material may have some additional points. The presentation may be a little bit different than CA material. But overall, if you see the content wise, they are same. So therefore, if you listen to these, lectures, carefully, then definitely you are going to enjoy the subject, and you are going to cover so many points in a quick time. That is the assurance I can give you. Now, sir, you see the institute study material. First, advanced accounting, module 1, chapter 4. So this is what? Presentation and disclosure based accounting standards. In accounting standard, the first module will have presentation and disclosure based accounting standards. Now, in presentation and disclosure based accounting standards, we have accounting standard 1, accounting standard 3, accounting standard 17, accounting standard 18, accounting standard 24, accounting standard 20. Like this, 5 or 6 standards are there. All those standards comes under presentation and disclosure based accounting standards. Now, what is this presentation and disclosure based accounting standards? See, our ultimate object of learning accounting standard is to understanding the financial statements, or improving the true and fairness of financial statements by applying the principles which is given by the accounting standards. Now, some accounting standards will, talks about the presentation of financial statements, disclosure of information in the financial statements. Now, some accounting standards will give you some principles. Those principles predominantly affect the presentation and disclosure of accounting standards. Now, in that series, the first standard what we are going to discuss is accounting standard 1. Accounting standard 1, that is disclosure of accounting policies. Disclosure of accounting policies. This is most underrated accounting standards. So many students thinking that this standard is not at all important, and they leave the standard. Or some students believe that this is a pure theory standard, so we can cover it at any time. So you should not take any chance, sir. In fact, this is a very good standard where there are so many new points there to learn. Okay, now let us continue our discussion here. See, first of all, what we are going to cover in this standard. See, in this standard, there are two major things we need to cover. First one is accounting policies. Accounting policy. Second thing is fundamentals of accounting. Fundamentals of accounting. I think these are the two areas. If you read this standard, these are the major two areas we are going to cover in this standard. The first area is accounting policy. Sir, in accounting policy, we are going to cover what is accounting policy, what is the necessity of accounting policy, and suppose a company want to select an accounting policy, what are the things they should keep in mind? So what considerations they need to keep in mind whenever they are selecting an accounting policy, and in respect of accounting policies, how the company should make its presentation and disclosure. And whenever a company wants to change an accounting policy, so what is the effect? How company is going to present the change of accounting policies in its financial statements? All those things we learn about accounting policies. The second thing is fundamentals of accounting. Fundamentals of accounting assumptions. So what are the fundamental accounting assumptions? So in respect of those assumptions, what we need to do, everything we need to discuss. Now, let us first discuss what is the need of the standard, why the standard came. See, in order to prepare financial statements, definitely some rules and regulations are required. Now, those rules and regulations are, there is no universal list which is applicable for every company. So because of the nature of the company, see, some companies will do manufacturing, some companies will be into insurance business, some companies into banking business, some companies will do, suppose for example, mining business, some companies will do banking business. See, there is a diversity in the business the companies do. Whenever they are doing different businesses, how each and every company will follow same policy, same rules, it is very difficult. So there is no universal list of accounting policies which is applicable for everybody. Moreover, every company has the freedom to select their own accounting rules, accounting policies, whichever suitable to their organization. So therefore, it is not possible to bring uniformity in the accounting policies which is to be followed by everybody. There is no universal list of accounting policies which is applicable to all the companies throughout the world or throughout India. So therefore, see, whatever ICI is trying to bring the uniformity. To the extent possible, they want to bring an uniformity. Because see, if there is a uniformity in accounting policies which is followed by companies, then the financial statements are comparable. We can compare financial statements so that we can increase the understandability, the reliability of the financial statements. See, as the framework which is suggested by ICI framework chapter, one of the important qualitative characteristics the financial statement should have is comparison. So how we can bring comparability in the financial statements? By preparing financial statements uniformly by following the same rules and regulations. Sir, on one hand you are saying there is no universal list of accounting policies which is applicable for everybody. On the other hand, you are saying ICI is trying to bring the uniformity so that they want to improve the comparability and quality of the financial statements. Yes. So the main object of this standard is, even though it is not possible to have a single exhaustive list of accounting policies, but for promoting better understanding of the financial statements, so whatever accounting policies you are following in your organization, why can't you disclose them in your financial statements? So we are agreeing to the fact that you follow different policies. Some other companies following some other rules and regulations. Depending upon the nature of the organization, definitely they will follow different accounting policies. So this standard is saying is, whatever accounting policies you are following, you just disclose it. So I think the main object of this standard is what? To ensure every organization to disclose the accounting policies, whatever they are following in the preparation of financial statements. Now, right away, I'm going to discuss first accounting policies, important. So whatever the order I am following, sir, you please follow the same order so that it will be, very much understandable to you. First, accounting policies, because this standard is talking about an accounting policies. First of all, what is an accounting policy? Simple. Accounting policies are specific accounting principles and methods of applying those principles which is adopted by the enterprise in the preparation and presentation of financial statements. So what is accounting policies, sir? Accounting policies are specific accounting principles, rules, and the methods of applying those principles. So specific accounting principles and methods of applying those principles adopted by the enterprise in the preparation and presentation of financial statements. So in the preparation and presentation of financial statements, which principles and which methods are adopted by the enterprise for preparation of its financial statements? So they are all called as accounting policy. Now, accountant has to make decisions from various options for recording or disclosing the items in the books of accounts. So see, in accounts, we have transactions. We will come across transactions relating to assets, transactions relating to liabilities. We come across transactions relating to capital, share capital. We come across transactions relating to incomes, expenses, everything. Now, for each aspect, which rules I need to follow, how I will record in my books, how I disclose these items in the financial statements. So for disclosure and for recording, what principles I need to follow as an accountant, I need to choose. Now that is accounting policy which I choose. Selection of accounting policy. For example, here items to be disclosed. What is the method of disclosure or valuation? For example, inventories. Take inventories. Inventories is common for a manufacturer or for a trader. Now, how inventory is to be valued? What methods we need to follow to determine the cost of inventory? For example, inventories are valued at the cost or NRV, whichever is lower. How to determine the cost? How to determine the NRV? FIFO method we are following or weighted average method we are following. Suppose cash flow statement. Suppose we need to prepare cash flow statement as per accounting standard 3. Which method we need to follow? Direct method, indirect method. There are two methods of presenting cash flow statement. Direct method, indirect method. Which method I need to follow? As an accountant, I need to choose. Now the whatever I choose, and that's my accounting policy. So basically, what is accounting policy? Accounting policies are principles and methods of applying those principles in the adopted by the enterprise in the preparation of financial statements. Adopted by the enterprise. That means these policies will change from organization to organization, because some X Limited adopted some accounting policy, Y Limited adopted some other accounting policy. For example, Reliance Industries Limited adopted weighted average method for determining the cost of inventory. Suppose, for example, Wipro Limited has adopted maybe FIFO method for valuing inventory. Example sake, I am saying. So whatever you chosen for your organization, that will be your accounting policy. See, this list is not exhaustive, that is endless. So it is not possible, na? This is the list, follow this list only, not possible. For every item, right from valuation of assets and liabilities to recognition of revenue, providing for expected losses, for each event, accountant need to form principles and evolve a method to adopt those principles. See, right from valuation of assets, liabilities to recognition of revenue. For example, in order to recognize revenue, which method I need to follow? For example, I am a construction company. For method recognition of revenue, for example, will I follow completed contract method or will I follow proportionate completion method? For example, providing for expected losses. For example, I'm expecting a loss. For that, I need to create a provision. For that, I should have an accounting principle and method. How to estimate the provision? There should be a method, right? Those are my accounting policies. So, for valuation of assets, how to value the assets? For example, as per accounting standard 10 pp, I want to revalue the assets at the end of the balance sheet. For example, I am following revaluation model. So that model, what I want to follow for revalue assets valuation, that is my accounting policy, which whatever I selected. And liabilities, valuation of liabilities. Suppose, for example, I want to determine the liability. So I want to create a provision for a liability. So which method I need to follow? How do I create a liability provision? How to make valuation of a liability? For that, what provisions I am following? So this method of forming and applying accounting principles is known as accounting policies. So what is accounting policy? The principles and methods adopted by the enterprise in preparation and presentation of financial statements. And this is endless list, exhaustive list. So it is not, there is no universal list of accounting policies which is applicable to everybody. Okay. Now, why this standard came, sir? Once we understood what is accounting policy, now we go to the first introduction paragraph. There they said the purpose of accounting standard 1 is disclosure of accounting policies is to promote better understanding of financial statements by requiring disclosure of significant accounting policies in an orderly manner. See, disclosure of which policies? Significant accounting policies. So the main object of AS1 is to promote better understanding of financial statements. Promote better understanding of financial statements. How you can promote better understanding of financial statements? By just disclosing what policies, what principles and methods you are following. Just disclose it so that users will understand, oh, this company has followed these principles and prepared financial statements. As explained in the preceding paragraph, such disclosures facilitate more meaningful comparison between financial statements of different enterprises for same accounting period. So, for example, this is the year 22-23 or 23-24. Now, in the year 23-24, if I am comparing financial statements, either I can compare my this year financial statements with previous year financial statements, or I may compare my financial statements with my competitor financial statements. Now, when I compare, the comparison should give me meaningful results. When they will give meaningful results, only if I can able to understand the differences in accounting principles and methods we follow. Suppose if I follow one method, my competitor followed another method, then in such a situation, without understanding the differences, if I compare, then definitely it will give wrong results. So it should not be the case, because financial statements plays an important role in decision making. So those who are depending upon the organization, those who are users of financial statements is a very important document. Therefore, it should provide a meaningful comparison. So to enhance that future, this accounting standard 1 is introduced. So I can say that accounting standard 1 main purpose is comparing financial statements to improve or to bring uniformity in the accounting policies, or for that matter, disclose all the accounting policies whatever you followed, so that we understood what policies, what rules you are following in the preparation of financial statements. Okay. The standard also requires disclosure of changes in accounting policies, such that the users can compare financial statements of the same enterprise for different accounting periods. So this accounting standard applies to all enterprises. So there is no, exception. This standard has to be followed by everybody. And you compare your financial statements of current year with previous year, or you can compare with others. For both the things to be done, you should disclose the accounting policies, what you are following in the preparation of financial statements. So that is the best main objective of accounting standard 1. What is it? Better understanding of financial statement. You should disclose all significant accounting policies. So we understood what is accounting policy. Then I told you about the main object of accounting policies. AS1. AS1 main objective is to disclose all accounting policies you are following in the preparation of financial statements. Now, the most important topic in this chapter, in this standard, is selection of accounting policy. Sir, you said every organization can select their own accounting principles and methods. Now, is there any criteria to select those principles? Yes, there is a selection criteria. Now, accounting standard 1 has given the criteria. The accounting standard 1 is saying that the first criteria for selecting an accounting policy is true and fair view. Because what is the main object of financial statements? The financial statement should give true and fair view. Now, the accounting policy, what you are selecting, should support that view. So that's why true and fair view is the first criteria in selecting an accounting policy. Whether the policy, what I am following, whether the principles and methods, what I am selecting, is it reflecting the true and fair view? Is it enhancing the truth and fairness of financial statements? So, if the policy what I am selected is not enhancing the truth and fairness of financial statements, then we should not follow those kind of accounting policies. So that's why they are saying financial statements are prepared to portray a true and fair view of the performance and state of affairs of the enterprise. So true and fair view, this is the main important point. In selecting a policy, alternative accounting policies should be evaluated in that light. That means they are saying that what is the first criteria? What is the first criteria for selecting an accounting policy? Main criteria, true and fair view. This is our main objective. So whenever anybody wants to select an accounting policy, whether this policy gives you true and fair view. Is it improve the financial statements truth and fairness? If answer is yes, then follow. Otherwise, no. Now, apart from this major consideration, there are some other considerations. See, in particular, major considerations that govern the selection of accounting policies. See, there are some other other considerations also. First, for example, prudence concept we should keep in mind. Next, substance over form. Next, materiality. So, three things: prudence, substance over form, and then materiality. These are the major considerations in selecting an accounting policy. The first criteria, true and fair view, that is always there. And other considerations, prudence, substance over form, materiality. Now let us discuss one by one. First, prudence. Sir, what is prudence? The prudence says profits should not be anticipated, but losses should be recognized. Losses can be anticipated and recognized. So always the concept of prudence is, when it comes to profits, don't anticipate. When profits are certain, you recognize them in the books. But what about losses? Always you can anticipate the losses. That means you can predict, estimate the losses, and then you can recognize them in the books. When it comes to profits, don't anticipate it. Don't recognize without certainty. So see here what material says, study material, exact content. In view of uncertainty associated with future events, profits are not anticipated. You don't anticipate profits, but losses are provided for as a matter of conservatism. Conservatism means prudence. So losses are provided as a matter of conservatism. You anticipate, you recognize now. No need to wait. And further, provision should be created for all known liabilities and losses, even though amount cannot be determined with certainty, and represent only a best estimate in the light of the available information. Superb. So these points can be asked as an MCQ. See here what they are saying is prudence concept. Provision should be recognized for all known liabilities and losses, even though amount cannot be determined with certainty, and it represents only an estimate in the light of available information. That means when it comes to losses, and liabilities, even though you don't know how much amount of liability, how much loss you are going to incur, no need, you just estimate it and recognize. Entire accounting standard 29, sir. 29 is the classic example, because accounting standard 29 talks about provisions. Now what they are saying about a provision is a liability which can be measured with a substantial degree of estimation. That means a liability with an estimation is a provision. That means always prudence concept supports the concept of estimation, but only in respect of liabilities and losses. So you create a provision for loss, or you create a provision for liabilities even though you don't know the amount. Of course, you can able to estimate it and you can recognize in the books. Sir, what about incomes? Can I estimate and recognize? No. What about an asset? Can I estimate and recognize? Answer is no. So in exercise of prudence in selection of accounting policies ensures that the final conclusion, profits are not overstated. Don't overstate profits. Losses are not understated. Losses should not be understated. Assets are not overstated. Liabilities are not understated. So always 4 things you should remember. Prudence concept. Profits, no overstatement. Losses, no understatement. Assets, no overstatement. Liabilities, no understatement. So remember, assets, incomes, same rule. Liabilities, losses, same rule. So when it comes to liabilities and losses, always they should not be understated. But when it comes to assets and profits, they should not be overstated. So this is the first consideration you have to select. That means whenever an organization is selecting an accounting policy, they should keep in mind whether this policy what we are selecting in preparation of our financial statement, is it overstating any assets? Is this policy is overstating my profits? Now, if that is the case, such kind of policies we should not follow. Now, in study material, sir, they have given one beautiful example, sir. This example can be given in MC as an MCQ. So, see this example, we'll discuss it, very, very important. The most common example of exercising of prudence in selection of accounting policy is the policy of valuation of inventory. See, valuation of inventory is the classic example for prudence. Why, sir? We'll understand this. Because what is the valuation principle, sir? Lower of cost and NRV. So, cost or NRV, whichever is lower, this is the policy we are following, right? Suppose a trader has purchased 500 units of certain articles at a 10 per unit. He sold 400 articles at 15 per unit. If the net realizable value per unit of the unsold article is 15, the trader should value his stock at a 10 per unit, and thus ignoring the profit of 500 that he may earn in the next accounting period by selling 100 units of unsold articles. Suppose, sir, what they are saying is there is a trader who purchased 500 articles, and what is the cost of the article? The cost is, suppose for example, the cost is 10 rupees. Now, he sold each article at 15 rupees. That means net realizable value. Net realizable value is nothing but the sale price. We can sell it, if you want to sell it in the market, at what price you can sell after reducing sale expenses. That is called NRV. Suppose the NRV is 15 rupees. That means you can able to sell at 15 rupees. So you have 500 articles. Out of that 400 articles you sold. So what is the remaining articles? 100 articles. Now these 100 articles you can sell it at 15. But the standard says at what value you need to value this? Cost or NRV, whichever is lower. Whichever is lower means 10. Therefore, I need to value the inventory at 1000 rupees. I cannot value at NRV. That means I cannot anticipate the future profit. Sir, you cannot say that, sir, these 100 articles may be sold in the next year. If I sold in the next year, I can sell it at 15 rupees. My cost is 10. Therefore, 5 rupees is my profit. So 500 profit I will anticipate. No, prudence says no, you should not anticipate profits. Profits are recognized only when there is a certainty. So here, ignoring the profit of 500 that he may earn in the next accounting period by selling 100 units of unsold article. Same manner, if the net realizable value per unit of the unsold article is 8, the trader should value his stock at 8 per unit, and that recognizing possible loss of 200 that he may incur in the next accounting period by selling 100 units of unsold articles. Suppose for example, instead of 15, your NRV is 8, sir. Then, sir, that means you are selling one article at 8 rupees, which is less than cost. So 2 rupees is your loss. So can I say 100 articles still is there unsold, into 2 rupees is the loss. So therefore 200 is my loss. Can I recognize that loss? Yes, you can recognize that loss in your books. This is prudence. So prudence says don't anticipate profits, but anticipate losses. So this is how we need to value the inventories. Now that means, suppose in the second case, the cost 100 articles, cost is 10,000. NRV 100 articles, each one 8 rupees. So 800. Whichever is lower, that means we are valuing the inventory at 800. So there is a loss of 200 we are recognizing. We are bringing the inventory from 1000 to 800. So there is a loss of 200 we are anticipating now. This is prudence concept. This is prudence concept. This is how we need to follow. Okay. This is example number 1. See example number 2. Exercise of prudence does not permit creation of hidden reserve by understating profits and assets or by overstating liabilities and losses. Suppose a company is facing a damage suit. No provision for damages should be recognized by charge against profit unless the probability of losing the suit is more than the probability of not losing it. See, what they are saying is, suppose there is a case pending in the court. Some third party has filed a case against you. Now, if you lose the case, you have to pay the damages. If you don't lose the case, no need to pay any damages. Now, my question is, At the end of the year, suppose this case is pending in the court, will you recognize a provision for the damages? The thing is, what is the probability of losing the case? If the probability of losing the case is more than probability of not losing it, then you can create a provision. So always you should say, for example, you should ask your lawyer, what is the winning probability? He said 40%. Then definitely that means loss 60%. Therefore, the probability of losing is more than probability of winning. Therefore, you can anticipate the loss there. You can create a provision. So this is example number 2, a case pending in the court. In that case, can I recognize a provision? That depends upon the probability. Probability of losing should be more than probability of winning. So this is the first criteria for selecting an accounting policy, that is prudence. Now substance over form. Sir, this is also very important point, sir. One more point you should remember when you are selecting an accounting policy is substance over form. Sir, what is substance over form? See, always importance is given to the reality, financial reality of the transaction rather than the legal formality. Substance over form, substance and main. So over form means legal form, legal formality. Always importance is given to the reality, financial reality, not just to the legal formality. See, that means in accounts we always follow substance concept, not the legal concept. Best example could be, suppose for example we purchased a property. See, when you purchase a property, you have to see whether that property is in your control. Are you enjoying the recent returns of that property? So whether you are controlling the future economic benefits of that property, if it is so, then that property will be your asset. You can recognize in your books, even though legally you may not the owner. See, in accounts we don't see legal ownership. See, registration of the property is only security purpose, but we need to see what is substantial, what is the financial reality. So transactions and other events should be accounted for and presented in accordance with their substance and financial reality. We have to see the substance and financial reality and not merely by their legal form. Don't just see the legal formality, see the substance and financial reality. For example, we purchased a building. Now we have given the entire amount, that owner has given us the possession, and we will register this property after 3 months. Now you tell me, immediately after taking possession of the property, you are enjoying the control over that property, you can use that property in whatever manner you like, then definitely the financial reality, the substance is that you are the owner, you are enjoying the future economic benefits, therefore you can record it in your books too. So legal formality, legally the property may be registered in your favor, in your name after 3 months, but we don't see the legality, we don't give importance to the legal format, but we give importance to the substance and financial reality. This is one important point while selecting an accounting policy. Now, one more important point you should keep in mind in selecting an accounting policy is material. Sir, the accounting policies should give importance to materiality concept. And one more important point, sir, the financial statement should disclose all material items. Now, what is material item? Simple. The knowledge of which will influence the decisions of users of financial statements is called material item. Anything which is influencing your decision is material. Suppose if it is not influencing your decision, then it is not material. It is not material. Sir, what is material, what is not material depending upon the organization size? And there are two things which will affect the materiality concept. One is the nature, another one is size. So nature and size, these are the two factors will influence the materiality concept. So first thing, financial statement should disclose all material items. And what is a material item? The item, the knowledge of which will influence the decisions of users of financial statements. Now materiality is not always a matter of relative size. See, you can't say because of the size, because of the amount, it is always material. No. So sometimes the nature will also affect the materiality. So the materiality cannot always be judged from amount point of view. See, size means amount. It cannot be always judged from amount point of view. You have to judge based on nature also. For example, a small amount lost by a fraudulent practices of certain employees can indicate a series of flaw in the enterprise internal control system requiring immediate attention to avoid greater losses in future. For example, sir, there is a cashier in our organization, and every day, suppose for example 100 rupees, he is misappropriating it. So suppose there is a theft of 100 rupees every day. Every day 100 rupees there is a theft in our organization, cashier is misappropriating. Tell me, and your company turnover is 10 crores. Tell me, is it material or not? Turnover 10 crores, sir. Every day cashier misappropriating 100 rupees. So depending upon the turnover, 10 crores, only 100 rupees is not material. If you see size, not material. But if you see the nature, it is definitely material. Because what they're saying is, every day misappropriation, small amounts misappropriation from the organization indicates lack of proper internal control system, which is a major threat to the organization in future. So therefore, you cannot say always materiality is linked with amount. Sometimes materiality depends upon the nature. So not having proper internal control system in the organization is a material item, because as of now 100 rupees only misappropriated, but in future this will lead to greater losses. So therefore, in certain cases, quantitative limits of materiality is specified. Now a few of such cases is there below. Now these are very important, Anna. This one and this one very important. Everybody, I think this can become as an MCQ. See, what this point is saying is, actually this point is taken from schedule 3. See, if you read schedule 3, P&L account, there is one point. What they're saying is, every company, when they are preparing financial statements, P&L account, notes to accounts, they need to disclose separately. They need to disclose separately in respect of each income or expenditure that exceeds 1% of revenue from operations or 1 lakh, whichever is higher. They need to disclose 1% of revenue from operations or 1 lakh, whichever is higher. For example, your revenue from operations, okay, 50 crores. So 50 lakhs, for example, 50 lakhs into 1%. So 50,000 or 1 lakh, whichever is higher, remember, whichever is higher means 1 lakh. Now, any income or expenditure exceeds 1 lakh. For example, there is an income which is exactly 1 lakh. Is it required to be disclosed separately? No, because schedule 3 says any income or expenditure which exceeds 1% of revenue from operations or 1 lakh, whichever is higher. Now, when schedule 3 itself is saying that any income or expenditure, if it exceeds the threshold limit, it has to be disclosed separately. Definitely, this is a material item. So sometimes the material items are decided by the law itself, the standard itself. Now the standard itself has, the schedule 3 has decided the materiality concept. So if anybody asks you what is the best example for materiality, you can write that. According to schedule 3, any income or expenditure which exceeds 1% of revenue from operations or 1 lakh, whichever is higher, this is a classic example of material item, and in respect of that we need to disclose all additional information. And also in study material, they have given one more example, sir. This example also taken from schedule 3. In schedule 3, sir, when we are discussing share capital, there is one point that shareholders holding more than 5% of the shares should be disclosed, and the name, the number of shares held by each shareholder should be disclosed. Shareholder holding more than 5% shares, specifying the number of shares held, should be disclosed separately. The company should disclose in notes to accounts the shares in the company held by each shareholder holding more than 5% shares, specifying the number of shares held. So this is also one of the examples for materiality, because schedule 3 saying shareholder holding more than 5% share disclosed separately. So understand, whenever it is a material item, sir, what we need to do, that material item should be bring to the users of financial statements. How? By making a separate disclosure. So the policy what you are following, the policy what you are going to select should support this concept of materiality. The accounting policy selected by you should contain all material items, and it allows the presentation of material items in the financial statements. Okay, so these are the major considerations for selecting an accounting policy. Come on, tell me what are the major considerations for selecting an accounting policy. First one, true and fair view. Next, other major consideration, three other major considerations. What are those? Prudence. Prudence means we can anticipate all possible losses, but we should not anticipate profits. And provision should be created for all known provisions and losses, but not assets. Okay, two examples we discussed. Next, substance over form. In accounts, we give importance to the financial reality and substance, not just to the legal formality. Third one, materiality. Materiality means any material item means the information of which will influence the decisions of users of financial statements. Materiality depends upon two things: nature, size. You cannot always judge from the size point of view. Best example I told you, for example, a cashier or a small amount of the cash is misappropriated by the cashier every day. So definitely it's a material item, because which shows the lack of internal control systems in the organization. And also two examples are there from schedule 3. First one is in schedule 3, any income or expenses having exceeded 1% of revenue from operations or 1 lakh, whichever is higher, has to be disclosed separately. Second thing is, as per schedule 3, a shareholder holding more than 5% of the shares has to be disclosed separately. Now, next, manner of disclosure. Sir, okay, we discussed what is accounting policy. We also discussed whenever we want to follow an accounting policy, whenever we want to select an accounting policy, what considerations are taken into mind, we discussed. Next, manner of accounting disclosure. See, what is the main object of AS1, sir? Disclose all accounting policies. Now, how to disclose it? What is the manner of disclosure? Accounting standard 1 says, all accounting policies adopted in the preparation and presentation of financial statements should be disclosed at one place. See, they are all disclosed at one place. See here, all significant accounting policies adopted in the preparation and presentation of financial statement should be disclosed. First of all, there should be disclosure of all significant accounting policies. Second of all, the disclosure of significant accounting policies as such should form part of the financial statements. They should form part of financial statements. Every company in the notes to accounts, they should disclose all the accounting policies, whatever they are following. And the significant accounting policy should normally be disclosed in one place. They should not be scattered. They should not be scattered throughout the financial statements. All significant accounting policies should be grouped in one place. So this is the disclosure of accounting policies, manner of disclosure. So 2 points you have to remember. First point, all accounting policies, significant accounting policies should be disclosed and it should be part of financial statements. Second point, the significant accounting policies should be disclosed at one place. Okay. Now next is once you learn about accounting policies, there is one more concept, sir, that is fundamental accounting assumptions. Sir, accounting standard 1 also talks about fundamental accounting assumptions. Sir, what is fundamental accounting assumptions? See, generally everybody, whoever prepares the financial statements, these assumptions are hold good. We assume that they have followed these things unless otherwise prescribed. Three things: going concern, consistency, accrual. So these are the three fundamental accounting assumptions: going concern, consistency, accrual. If organization has followed them, no need to make a separate disclosure. No need to tell we followed accounting fundamental accounting assumptions in preparation of financial statements. No need to disclose. Suppose if not followed, then make a specific disclosure in the financial statements. State that, sir, we have not followed the fundamental accounting assumptions in the preparation of financial statements. Of course, this fundamental accounting assumptions is not important, but we'll just discuss it. First, going concern. What is going concern? See, whenever you are preparing financial statements of an organization, so we assume that the organization will continue for future period, will continue for foreseeable future. Neither it has the intention nor has the necessity to curtail its operations. That means organization will continue for the next year or next year. So that is the assumption. So because when an organization is not a going concern, sir, then the way we prepare financial statements will change. So that's why, unless otherwise prescribed, we always assume by looking at the financial statements that this organization is a going concern. This will continue for future period also. They have the intention to continue the business. The financial statements are normally prepared on the assumption that an enterprise will continue its operations in the foreseeable future. And neither there is intention nor there is need to materially curtail the scale of operations. Financial statements are prepared on going concern basis, recognize among other things the need for sufficient retention of profit to replace the assets consumed in the operation and for making adequate provision for settlement of its liabilities. Sir, why this assumption is very important is, if you continue your organization for foreseeable future, definitely the assets have to be replaced, because these assets, the current assets will have a limited period of time. Immediately, once the life is over, we need to replace with some other assets now. So that means we need to ready for future. So we need to arrange the funds for acquisition of assets, replacement of the existing assets. Second thing is liabilities. So to anticipate the future liabilities, we should create a provision. So creation of provision, setting aside funds for replacing the assets. So to do these things, there should be going concern assumption hold good. So that's why we are asking whether you followed going concern assumption in the preparation of financial statements. If you have not told anything, then we assume that you followed it. Next, consistency. Sir, whenever we are following accounting policies, there should be consistency. Consistency means this year what the policy we are following, next year also the same policy will be followed. Okay, we don't change the accounting policies often. So that practice of following the same policies every time is called consistency. So the principle of consistency refers to the practice of using same accounting policies for similar transaction in all accounting periods. The consistency improve what? Comparability of financial statements through time. But of course, the standard says we are not saying that you cannot change an accounting policy, but better you follow consistency. But there are three situations. There is a chance that you can follow, you can change the accounting policy what you are following. That is by statute, by an accounting standard, for more appropriate presentation of financial statements. So when the law requires, then you can change the policy. Suppose by an accounting standard, when the standard requires, standard says you have to follow this policy. The standard says this principle. In order to adopt that principle, we may change the accounting policy. For more appropriate presentation of financial statements, see, for better presentation of financial statements, if you want to follow, you can follow. So there are three reasons the company can change the accounting policies. Tell me those three reasons. By statute, by accounting standard, for better presentation of financial statements. Now the third concept is accrual basis of accounting. Accrual concept. Sir, what is accrual concept? See, accrual concept means, see, in accounts there are two concepts: accrual, cash. Cash accounting, accrual basis of accounting. We don't follow cash basis of accounting, but we follow accrual basis of accounting. Even this method of accrual is endorsed by Companies Act. If you see section 128, if you read 128 of the Companies Act, it makes it mandatory for companies to maintain books on accrual basis only by following double entry system. Actually, double entry system word is also there in the section 128. So section 128 says every company has to maintain their books on which basis? Accrual basis. So when the law says something, you have to follow it. Now, what is accrual basis? See, transactions will be recognized when they occur in the business, irrespective of their cash position. Whether it is received, whether it is paid, that's a secondary matter. What you need to see is whether they have actually occurred in the business. So based on the accrual, based on the occurrence, if you are recording the transaction, that is called accrual concept. So transactions are recognized as soon as they occur, whether or not cash or cash equivalents is actually received or paid. Whether you received or not, that's a secondary matter. Now, this accrual concept is the best example. See, why this accrual concept came now? To match the revenue and cost. So, to matching concept. See, accrual concept always support which concept, sir? Matching concept. Matching. You need to match what? Your revenues, expenses and losses. How you are going to recognize? How you are going to match? What is the income you earn? What are the related expenses? Both will be recorded in the current period itself. then only the revenues and expenses will be matched. That's why this concept of accrual came, which says expenses will be recognized when they occur. So here in study material, one good example is there, sir. I will tell you. See here. While accrual basis is for more logical approach to profit determination than the cash basis of accounting, it exposes an enterprise to the risk of recognizing an income before actual receipt. The accrual basis can therefore overstate the divisible profits, and dividend decisions based on such overstated profit lead to erosion of capital. For this reason, accounting standard requires that no revenue should be recognized unless the amount of consideration and actual realization of the consideration is reasonably certain. So, the best example, sir. Sir, prudence accrual. Sir, is accrual concept is violating prudence concept, sir? Answer is yes, maybe, because accrual says you need to recognize incomes, you need to recognize expenses when they occur. For example, we sold the goods. We sold the goods. Now, the moment we sell the goods, we are recognizing in the books, right? Our assumption is there is a certainty. Accounting standard 9 is there actually. Accounting standard 9 says whenever you have sold the goods, when will you recognize revenue? First of all, there should be transfer of risk and rewards. Second of all, there should be certainty in collection. Certainty in price and certainty in collection. There should be certainty in collection. Only when there is a certainty in collection, you should recognize the revenue, right? So accounting standard 9 says whenever you sold the goods, there should be certainty in collection, then only you recognize in the books. Why accounting standard 9 is saying that? Because accrual concept is there saying whenever a transaction occurred, you are recognizing. For example, I sold the goods. I recognized in the books without certainty in collection. So that means I'm overstating my profits, overstating my incomes. Now, based on that, suppose if company declares dividend, there is an erosion of capital. Now, that's why accounting standard has been brought the concept of whenever there is an income, the income must be certain to collect, then only it will be recognized. So therefore, remember, accrual concept sometimes may violate the concept of prudence, but then accounting standards came into picture and rescue the concept of prudence and made an exception for accrual concept. That means whenever we sold the goods, whenever we earn income, we will recognize only when there is a certainty in collection as per accounting standard. That means we are not recognized when they occurred. When sale happened, we don't recognize. See, most of the times what happens now, whenever you come across sale of goods, you will recognize it as a revenue. Why? Because there is a assumption that there is a certainty in collection. But if you read accounting standard 9 properly, it is clearly saying only when there is a certainty in collection, you should recognize revenue. So therefore, in practice, we will recognize the revenue only when there is a certainty, not just we are following accrual concept. Of course, accrual concept hold good for expenses, but when it comes to incomes, we should follow accounting standards also. Okay. See here, despite the possibility of distribution of profits not actually earned, accrual basis of accounting is generally followed because of its logical superiority over cash basis of accounting. So despite the possibility of distribution of profits not actually earned, so accrual basis is generally followed because of its superiority. Definitely accrual concept is far more superior than cash basis of accounting. Okay. So it is not necessarily to expressly state that accrual basis of accounting has been followed in preparation of financial statements. In case any income expenses is recognized on cash basis, the fact should be disclosed. The fact should be stated. So it is not that we are following accrual basis of accounting. No. So sometimes if any incomes on expenses are recognized on cash basis, then we have to disclose that fact. So I think these are the three fundamental accounting assumptions. Tell me, sir, what are the fundamental accounting assumptions? Going concern, consistency, accrual. What is going concern? An organization will continue for foreseeable future. It is neither have the intention nor have the necessity to curtail its operations. Okay. What is consistency? Following the same principles for similar transactions over a period of time. Better you follow consistency. But of course, there are three situations you can change: by statute, by accounting standard, for better presentation of financial statements. Accrual concept, recognize the transaction as and when they occur, irrespective of the cash position. Okay. So, but don't, violate prudence concept. So, accrual concept, subject to accounting standard, you need to follow. So, we discussed. And there is a last concept, sir, that is the concept of disclosure of changes in accounting policies. Sir, sometimes we may change the accounting policy. For example, we are following inventory valuation FIFO method. Now we are changing to weighted average method. It is allowed if it is required by law, if it is required by standard, if it is for better presentation of financial statements. Definitely it is allowed, sir. It is allowed. Now standard says whenever there is a change in accounting policy, now you have to see whether that change is material or immaterial, not material. Sometimes it is material in current period. Sometimes it is not material in current period, but ascertainable in later periods. See, whenever you change the policy, any accounting policy, the effect of that change may have a material effect in current period. What is material? I discussed. Anything which influence the decisions of users. Materiality depends upon the nature and amount. Either based on amount or based on nature, you decide materiality, depending upon your organization. Now, if this material in the current period and you are able to ascertain the amount, then amount should be disclosed. Suppose you are shifting from FIFO to weighted average method. Now, because of this, your inventory value has decreased by 50,000. Now, if this decrease of inventory by shifting from FIFO to weighted average method, material and amount is ascertained, disclose it. Sometimes material, but amount is not ascertained because we can't quantify in a financial term. Sometimes it is not possible. Then at least disclose the fact that we have changed it from FIFO to weighted average method, and because of that, the financial effect on inventory we are unable to ascertain. Sir, why you are unable to ascertain? See, in accounts, there are some fundamental rules. There is a concept called framework chapter, which says when an asset is recognized in the books, only when there is a reliable measurement. So it may not be possible to measure all assets reliably at the same time. Therefore, in such a situation, just a fact to be disclosed. Suppose sometimes it is not material in the current period, but it is ascertainable in later periods. Now, fact of such a change in later period to be disclosed in the current period. Suppose, for example, there is a change in accounting policy which may not be material in current period, but will affect the future accounting. For example, the change in method of inventory valuation from FIFO to weighted average method, which may not have material effect in the current year inventory, but definitely it is going to affect our method of valuation of inventory in the future periods. If that is the case, then you should disclose the fact that there is a change and that change is going to affect our inventory valuation for the future periods. In study material, sir, one example given, sir. A simple disclosure that an accounting policy has been changed is not much use for a reader of financial statement. The effect of change should therefore be disclosed wherever ascertainable. Suppose a company has switched over to weighted average formula for ascertaining the cost of inventory from earlier practice of using FIFO. If the closing inventory using FIFO method is 2 lakhs, for example, we are valuing inventory under FIFO method 2 lakhs, and that by weighted average method 1.8 lakh. Okay, that means there is a decrease of inventory by 20,000. The change in accounting policy pulls down profit and value of inventory by 20,000. Okay, definitely when the closing inventory is decreased, now our profit will also decrease. The company may disclose the change in the accounting policy in the following manner. See, now accounting standard 1 says there is a change in accounting policy. Now how you are going to make a disclosure? See here. The company values its inventory at lower of cost or NRV. Since NRV of all items of inventory in the current year was greater than the respective cost, the company valued its inventory at cost. In the present year, the company has changed to weighted average method, which better reflects the consumption pattern of inventory. Reason they are explaining: for ascertaining inventory cost from earlier practice of using FIFO method for this purpose. The change in policy has reduced profit for the year and the value of inventory by 20,000. So that is what we discussed now. Change in accounting policy, which is having a material effect, amount ascertainable, disclose it. So entire this paragraph meaning is that only. We are disclosing the amount because the effect is ascertainable. Okay. A change in accounting policy is to be disclosed if the change is reasonably expected to have a material effect in future accounting periods, even if the change has no material effect in the current accounting period. Sometimes the change in policy may not have a material effect in the current period, but it may affect our future periods. So the above requirements ensure that all important changes in accounting policies are actually disclosed. So I think we have discussed the entire contents of the standard, sir. Now there are some questions in study material. Please solve it immediately. Now we will see MCQs from study material. See, which of the following is not a major consideration? Not a major consideration in selection and application of accounting policies. Tell me, what are the major considerations in selecting an accounting policy? Prudence, substance or form, materiality. So prudence, substance or form, materiality. These three are major considerations. So which is not a major consideration? Comparability. So answer is B. B is not a major consideration. Next, adoption of different accounting policies by different enterprises operating in the same industry affects which of the qualitative characteristics the most? See, adoption of different accounting policies by different companies operating in the same industry. Suppose, for example, cement industry. Okay, there are 50 companies in cement industry in a particular state, for example. Now, these 50 companies are following different accounting policies. Now tell me, which of the qualitative characteristics will be affected? Definitely comparability. So comparability will be affected because same industry, companies, one company is following which policy? Some policy, another company is following different policy. So that is one thing. Next, which of the following statement would not be correct, should not be correct in relation to disclosures to be made in the financial statements after making any changes in accounting policies? So which of the following statement would not be correct? So you have to select incorrect statement whenever there is a change in accounting policy. First, any change in accounting policy which has a material effect should be disclosed. Okay, correct. Any change which is having a material effect should be disclosed. Next, the amount by which any item in the financial statement is affected by such change should be disclosed to the extent ascertainable. Okay, where such amount is not ascertainable, wholly or in part, the fact should be indicated. Correct. If a change is made in accounting policy which has no material effect on the financial statement for the current period, but which is reasonably expected to have a material effect in later period, the fact of such change should be appropriately disclosed in the period in which the change is adopted. Correct. So if change is made in an accounting policy which has a material effect on the financial statements for the current period and is reasonably expected to have a material effect in the later period, the fact of such a change should be appropriately disclosed only in the later periods, that is the year next to the year in which the change is adopted. Wrong. So suppose there is a change in accounting policy, that change may not have material effect in the current period or which may expected to have a material effect in the future periods. The fact should be disclosed in the current year only. We have discussed in and this point here. In the chart we discussed this one. The fact of such change in later period to be disclosed in current period only. So therefore the correct answer, the incorrect answer is the last one. The incorrect answer is last. So that means B, A, D. So these are the answers. So this is accounting standard 1, sir. I have covered everything. So please listen to this accounting standard at least 2 times so that it will fit into your mind. After that, try to solve illustrations and theory questions from the study material. Okay. Thank you, students. We'll meet in the next standard.